Sometimes one single decision can change absolutely everything. Well, back in 1963, a Supreme Court case did just that for American banking. It's this wild story about a planned superbank, a big fight inside the government, and a legal question that honestly nobody had really thought to ask before. So, let's dive right in. All right, picture this. It's 1963. We're in Philadelphia. You've got this city steeped in history and industry, but behind the scenes, in the quiet world of finance, a storm is brewing. So, what was all the fuss about? Well, it all starts with a really ambitious idea. Two of the biggest banks in the city looked at each other and said, hey, what if we teamed up? They wanted to create a financial giant, something Philly had never ever seen before. Okay, so who are we talking about? Our main players are the Philadelphia National Bank, we'll just call them PNB, and the Girard Trust Corn Exchange Bank. Now, these guys weren't just any old banks. They were absolute pillars of the Philly economy. And they were about to do something that would get everyone in Washington, D.C. talking.
And this is where it gets really interesting. Just look at the scale of this thing. If this merger went through, this new superbank would control 36% of all deposits in the entire Philadelphia area. I mean, think about that for a second. More than a third of the city's money in the hands of one single company. That's a huge amount of power.
So how did they possibly justify this? Well, their argument was pretty straightforward, and to be honest, it kind of made sense at the time. They basically said, look, we've got these behemoths up in New York City. If we want to compete on that level, we have to get bigger. We need to create our own regional powerhouse.
But, as you can probably guess, a plan this big didn't go unnoticed. It kicked off a massive conflict. And what's so fascinating here is this wasn't just a simple case of the banks versus the government. No, the real battle was happening inside the U.S. government itself.
So in one corner, you had the Comptroller of the currency. This agency gave the merger a big thumbs up. They agreed with the banks, saying we need bigger, stronger institutions to compete. But in the other corner was Bobby Kennedy's Department of Justice. They looked at that same 36% number and saw one thing and one thing only: the start of a dangerous monopoly.
This internal government clash forced a really fundamental question out into the open. It was about a belief everyone had about banking for decades, and that long-held belief was about to get its day in court, the Supreme Court, to be exact.
And what was this big, crucial question? It was this: did the laws that were designed to break up monopolies in industries like oil and steel even apply to banking? Now, it seems like an obvious question to ask now, but believe me, back then the answer was anything but clear.
You see, for decades, the general thinking was pretty much, no, of course not. Banks were just different. They were seen as this special, heavily regulated industry, so they were thought to be exempt from normal antitrust laws. Plus, a fairly recent law seemed to give regulators, like the Comptroller, the final word, keeping these kinds of decisions out of the courts completely.
But the Department of Justice just wasn't buying it. They dug in their heels and pushed the issue all the way to the Supreme Court. This was it, a legal showdown that was about to change the rules for the entire banking industry forever.
So, standing before the justices, the DOJ laid out a powerful and frankly prophetic argument. They warned, if you let this one merger go through, you're opening the floodgates. It'll lead to an America where just a handful of massive banks control the entire economy.
And then, the decision came down. In a ruling that absolutely stunned the financial world, the Supreme Court sided with the Department of Justice. The merger was blocked.
So what was the court's reasoning? It was actually simple, but completely revolutionary. They declared, for the first time, that banking is a form of commerce. It's a business, just like any other. And because it's a business, it had to follow the same rules as everyone else, making it subject to the Clayton Antitrust Act.
But the court didn't just stop there. Nope, they went a step further. They invented a brand new, bright-line rule just for banking. And it all came down to this one magic number.
This became known as the 30% rule. The court basically stated that any merger giving a single bank control of 30% or more of a local market was, on its face, a threat to competition and would be presumed illegal. Just like that, a new standard for an entire industry was born.
Okay, so a merger gets blocked, a new rule is made. What's the big deal? Well, what was the long-term impact of all this? The thing is, this single case from 1963 created ripples that we still feel in the banking world today. For the next 30 years, that 30% rule effectively slammed the brakes on the creation of huge regional banks. It kept the American banking system very fragmented and very local. Now, federal laws changed in the 1990s to allow for more consolidation. But, and this is the amazing part, that rule from 1963 is still around. Even now, when two massive banks merge, they often have to sell off local branches just to stay under that 30% local cap.
So, if you've ever wondered why the American banking system seems like such a complex, confusing web of different rules for local, state, and national banks, well, this case is a huge piece of that puzzle. It created this fundamental tension between wanting local competition and having huge national banks, a tension regulators are still grappling with.
Ultimately, the Philadelphia National Bank case was about way more than just one merger. It was the moment the Supreme Court declared that banks are not some special protected class. They're businesses. They drew a line in the sand back in 1963, and because of it, the entire financial landscape was changed forever.